A powerful supply squeeze signal has just triggered on Bitcoin. This is the same signal that marked every major market bottom over the past decade. It occurred at the bottom of the 2015 bear market before an 8,000% rally, the 2018 bear market before a 1,700% rally, and the 2023 bear market bottom before a 350% rally. Yes, all of these were driven by strong demand for Bitcoin, but each of these were accompanied by a shortage of Bitcoin supply. In fact, just like the signal in 2023 that occurred following the FTX collapse, we've seen today's signal trigger right after the tariff sell-off. And if we copy-paste the price action between these two instances, they are actually quite similar. You see, Bitcoin is a mathematical program and is extremely influenced by the supply at any given point. And this could be the reason why Bitcoin has been outperforming most other financial assets during the recent panic from Donald Trump's tariffs. The signal that has triggered today is suggesting that Bitcoin miners have just gone through a period of forced selling, now increasing the odds of a Bitcoin shortage that could ultimately lead to higher prices. Bitcoin miners are incentivized on whether to mine new Bitcoin or not, mainly based on profitability. Now, profitability depends on two key factors: Bitcoin's market price and something called the hash rate. The hash rate is what can be considered as the amount of competition there is in the mining space. It is the total computing power that is used to mine Bitcoin at any given time. When the hash rate is rising, it means competition is rising as more miners are coming online to mine Bitcoin, likely because of higher Bitcoin prices. And when the hash rate drops, it means miners are shutting off their machines because it's no longer profitable for them to continue their operations at the current Bitcoin price. So the hash rate can help us get an idea of just how much Bitcoin mining is happening. Over the long run, the hash rate goes up, but temporary dips are moments where Bitcoin miners are forced to sell. Once the selling pressure is fully absorbed, it eventually leads to a supply shortage for Bitcoin and corresponds to incredible buying opportunities. An easy way to spot these is by adding a long-term and short-term moving average on the hash rate. This tells us what the long-term behavior of miners is versus what they have been doing more recently. Whenever the shorter-term moving average is below the longer-term one, it is telling us that miners have reduced their production and that a Bitcoin shortage is more likely. And once the shorter-term moving average moves above the longer-term moving average, it triggers a buy signal, indicating that all the selling pressure on Bitcoin has been absorbed and the period of miner stress has finally come to an end. This is when supply tends to actually dry up and demand starts outpacing the reduced supply, creating a supply squeeze. So while hash ribbons doesn't directly measure supply, it signals the end of forced selling by Bitcoin miners and the start of a supply-driven rally.